Today, let's track the market hot spots and talk about Circle. Since it went public in early June, the market has been chasing it like crazy, with its stock price soaring from $31 to nearly $240, nearly 8 times in less than a month. Behind this, there is not only the policy support brought by the passage of the Genius Act by the U.S. Senate, but also the strong support of institutions such as Wall Street giant BlackRock and Cathie Wood's ARK Invest. On the surface, this is a perfect growth story. But as experienced investors, our job is not to follow the crowd, but to calmly examine, does this rocket, riding on policy benefits and institutional endorsements, have enough fuel? Is its current altitude, that is, market valuation, far beyond the height it can actually reach? In my opinion, the answer is yes. So far, Circle's market value is likely to have been seriously overestimated. The market seems to be looking at its distant, idealized future through a telescope, but selectively ignores the visible cracks at its feet. Next, we will peel off the risks behind this round of craze layer by layer, like peeling an onion, and explore how to dance with this high-risk, high-return opportunity from the perspective of a professional investor. To judge whether it is overvalued, we must first understand why the market gives it such a high valuation. Circle's business model, to use a simple metaphor, is like a special bank that does not lend. You give it $1 in cash, and it gives you a digital token worth $1, that is, USDC. Then, it will deposit the $1 in cash you give into an extremely safe, piggy bank, most of which are short-term U.S. Treasury bonds. Circle's main profit comes from the interest income generated by this huge, piggy bank of more than $61 billion. Based on this model, the market's bullish logic is mainly based on 3 fulcrums. 1. Regulatory pass. The Genius Act passed by the U.S. Senate has tailored a compliant road for Circle. The bill requires stablecoins to have sufficient cash and safe assets as reserves and to make regular reports, which is exactly what Circle has been doing. This gives it a huge moat, allowing it to distance itself from competitors that have been criticized for transparency, such as Tether. 2. Wall Street's endorsement. BlackRock, the world's largest asset management company, not only manages 90% of USDC's reserves, but also plans to purchase about 10% of its shares at the time of its IPO. This deep binding of top institutions provides Circle with unparalleled credibility endorsement. 3. The starry sea of the future. The market is looking forward to Circle not only being satisfied with earning interest. The Circle Payment Network, CPN, it is building is designed to subvert the traditional, slow and expensive SWIFT international remittance system. At the same time, the enterprise-level software services, APIs, it provides have the potential to make it the Stripe in the stablecoin field, that is, the world's leading payment platform in the stablecoin field, providing high-profit, high-stickiness infrastructure services. These 3 stories combined have ignited the enthusiasm of the market. But no matter how good the story is, it needs the support of data and reality. When we look closely at the data, cracks begin to appear. In my opinion, there are 3 clear cracks in the foundation that support Circle's high valuation, any one of which is enough to give investors a cold shower. Risk 1, growth engine stalled. The risk of stagnation of core business. This is the most fatal point. Circle's business model determines that its core income is directly linked to the circulation of USDC, that is, the size of reserves. The more reserves, the higher the interest income. However, USDC's growth has shown signs of stagnation or even shrinkage. According to CoinGecko data, USDC's market value has lost its growth rate since April this year, and even fell from a high of $62 billion in April to about $61.45 billion at present. In contrast, its main competitor Tether, USDT, has a market value of $153.4 billion, more than twice that of USDC. This data point is crucial. It means that Circle's piggy bank has not only not grown, but has a tendency to shrink. For a company that the market has given super high growth expectations, the stagnation of its core business is the most powerful rebuttal to its high valuation. Risk 2, the tightening curse of interest rates, the headwinds of the macro environment. Circle's profits are highly sensitive to interest rates. Every rate hike by the Federal Reserve is like adding fuel to its money printing press. But on the other hand, rate cuts will directly compress its profit margins. According to the current changes in the situation, the unfavorable factors of inflation are decreasing, such as the stabilization of the geopolitical situation, the impact of tariff factors on inflation is lower than expected, and coupled with the cooling of economic data, the Federal Reserve is likely to cut interest rates twice or even more than twice in the second half of 2025. This means that Circle's good days of earning interest income from its more than $60 billion in reserves may be coming to an end. Lower interest rates will directly lead to a slowdown in the growth of its revenue and profitability. The market currently seems to have completely ignored this major negative at the macro level. When a company's core business stagnates and its profit model faces macro headwinds, its stock price has skyrocketed 8 times in a short period of time, which is itself extremely unusual. Risk 3, the tortoise and hare race, with Tether, overestimated competitiveness. Circle has always used its transparency and compliance as selling points, claiming to be a good student in the stablecoin track. However, in business competition, being a good student is not enough. The comparative data in a report is shocking. Tether achieved a profit of $13 billion last year with its more aggressive reserve strategy and broader global crypto infrastructure integration. Circle's profit in the same period was only $156 million. The difference in profits between the two is more than 80 times. Although Tether's market value is only more than twice that of USDC, its profitability shows a crushing advantage. This shows that the market may have seriously overestimated the high valuation that Circle can convert into with its single-point advantage of compliance. How to understand it? We know that Circle's main income comes from the interest income generated by its USDC reserve assets, which are almost all invested in low-risk assets such as short-term U.S. Treasury bonds. On the one hand, Circle has become the most trusted stablecoin and has obtained legal status in the United States, but on the other hand, it has also become the ceiling of Circle's revenue growth. In 2024, Circle's revenue exceeded $1.676 billion, of which 95% to 99% came from interest income, and service income accounted for only about 0.9%. In addition, Circle's interest income on its USDC reserves must be shared with its partner trading platform Coinbase. In 2024, the distribution fees paid to Coinbase reached $908 million, which once again significantly compressed the profit margin. In contrast, Tether's income mainly comes from the interest generated by its huge collateral reserves. In 2024, the reported profit was as high as $13 billion, with an interest yield of about 4.72%, and it has a stable coin with a market value of more than $1.5 trillion. Tether's reserves include a variety of assets, U.S. Treasury bonds, corporate bonds, more than 100,000 bitcoins, precious metals, secured loans, etc., with high risks and returns. If we compare them to two fund management companies, Circle's income basically comes from time deposits, while Tether's income comes from time deposits and part of venture capital. In other words, Circle earns a fixed salary with a very low ceiling, while Tether is much more flexible, and in addition to the fixed salary, there are some side jobs that make money. Before Circle finds other sources of income, it is a bit presumptuous to give such a high valuation to such a company whose hands and feet are bound by regulatory laws. The current valuation given to Circle by the market seems to regard it as the winner of the race, but judging from the profit data, it may not even be able to see Tether's taillights. In addition to the above three major risks, there are some risks lurking under the water, which are covered by the market's enthusiasm. 1. The selling wave of giants. Early institutional investors are not philanthropists. After the surge in Circle's stock price, Cathie Wood's ARK investment has begun to systematically reduce its holdings and cash out, selling more than $243 million in shares in less than a week. This shows that some speculators have begun to withdraw in the short and rapid hype. Their selling will put continuous pressure on the stock price. 2. This is the hunting ground of giants, the fat piece of stable coin. Traditional giants cannot ignore it. Related reports mention that giants such as Amazon and Walmart have expressed their intention to launch their own stablecoins. Imagine if Amazon launches Amazon Coin, with its huge e-commerce ecosystem and user base, its impact on USDC will be devastating, not to mention that giants such as JP Chase may participate in the competition. The size of the stablecoin market is limited. When facing many strong opponents, it is a success for Circle to maintain its current market share. The difficulty of achieving sustained growth in this context can be seen. 3. Unlocking pressure of insiders. As a company that has been listed for less than a month, the shares held by Circle's insiders and early investors will face the lockup period unlocking in a few months. Historically, before and after the IPO lockup period is unlocked, the stock price is usually under great pressure due to the expectation of insider selling. Having said so many risks, does it mean that Circle is useless and we should avoid it completely? Not really. Circle is undoubtedly a company with excellent fundamentals and a favorable track. The problem is not the company itself, but its current price. So, as a rational and bold investor, how would you operate? An analysis article proposed a very smart strategy: selling put options, selling puts. Let me use an analogy to explain this strategy. It's like making a bet on house prices. Suppose a house you like very much is now priced at $2.4 million due to market speculation. You think it's too expensive and not worth the price. But you have a bottom price in your mind. If it can fall to $1 million, you are very happy to take it. So, you find someone who is eager to lock in the selling price and say to him, "I will sign a contract with you. You pay me a deposit of $19,000 now. In return, I promise that if the market price of this house falls below $1 million before March 20th next year, I must buy it from you for $1 million. If the house price is still above $1 million by then the $19,000 deposit will belong to me and the contract will be void." This is the essence of selling put options. Corresponding to Circle's stock, there will be two results. Result 1, the stock price does not fall below $100. By March 20, 2026, if CRCL's stock price is still above $100, then you don't have to do anything, just pocket the 19.65% premium income from the sell option and get out of it. Result 2, the stock price falls below $100. You will need to buy the stock at $100 per share. But because you have received the premium in advance, your actual holding cost is only about $80 per share. This is equivalent to buying the stock of a company you are optimistic about at a discount price of nearly 60% lower than the current market price. Under the premise that the company does not encounter any unexpected events, this price can be said to be a bargain. The beauty of this strategy is that it builds an asymmetric risk-return structure. Whether the stock price rises or falls, you can be in a relatively advantageous position. This reflects the very important margin of safety principle in investment. In short, Circle is an excellent company in the golden track and holding the trump card of compliance. Its future is full of imagination. However, the core principle of investment is, buy excellent companies at a reasonable price, and Circle's current price is obviously not reasonable. Its current market value has far overdrawn the perfect growth expectations for the next few years, and completely ignores multiple risks such as stagnation of core business, macro interest rate headwinds, fierce market competition, and institutional and insider selling. The market seems to be paying for an exciting story rather than a financial report with steady growth. The rocket that soared into the sky is indeed spectacular, but as investors, our task is not to cheer for it on the ground, but to calmly calculate its fuel reserves and the weather conditions ahead. In my opinion, the fuel of Circle's rocket, USDC growth, has bottomed out, and the wind direction ahead, interest rate environment, is about to reverse. A deep correction back to a more reasonable valuation range may only be a matter of time. Smart funds have begun to sell at high altitudes to make profits, and smarter funds may be on the ground, quietly waiting for an opportunity to take over this rocket at a bargain price through strategies such as selling put options. The above is a little information and personal opinion shared with you today. Thank you for your company, and I hope we can make progress together.